This is Aziz Gool. In my last video, I covered what it means to be an accredited investor. And today I want to talk to you about some of the investment vehicles that you have access to as an accredited investor, that only you have access to. I'm going to cover just a few of them. This is by no means a finite list or a comprehensive one, and is not investment advice in any way. But essentially, the main ones that we are going to cover are going to look at equity and debt. So in terms of being an accredited investor, you have access to private credit investments and then private equity investments, which is essentially investments in private companies. There are also things like hedge funds and listed investments, but that's not what we're going to get into today. So I just want to focus on two. The first one being private equity and the second one being venture capital. So private equity is investing essentially in growing businesses that are more established, and it's a lower risk relative to venture capital, because usually these companies are already established, they have existing customer base, product market fit, and are sort of at the late stage growth of their maturity, where essentially you're looking for an exit via IPO, which is an initial public offering. So investors that get involved in this, they usually invest north of $1 million in order to get access to the fund. If they're doing a fund level investment, you can do this as a direct investment as well, but obviously that has more risk. It requires more active management. And also one of the kind of hallmarks of this type of investing is that there is no liquidity as there is with public market investments, right? So your lockup period is generally 5, 7, 10 years. And over that period, you're looking at getting kind of an internal rate of return, or an average yearly return over that period of about 25%. Then we look at venture capital. Now, venture capital, on the other hand, is investing pretty much in outliers, right? So you're looking to back several early stage companies that don't necessarily have that much traction or product market fit yet, and are kind of looking at, how they get there, how they get profitable, and you basically backing them in order to shoot the lights out, right? So you're looking at getting, multiples back on your investment. Mark Anderson once said, you have one investment that returns the whole fund. So you're investing in outliers, the odds are against you, and you invest in 10, one might work. And often this is referred to as chasing unicorns. So these are companies like Uber, like Facebook, that have really disrupted the market and multiplied their value significantly over a very short period of time. But obviously, as an early investor, you won't know what that is until you've invested, you've backed the company, and again, there's potential illiquidity in that type of investing, long holding periods. So if you do get involved in this type of investing, remember, it is high risk, which is obviously the dichotomy between high risk and high reward. And remember that it's money that you do not need anytime in the short term. It's money you forget about, so that you can build generational wealth over time, over 5, 10, 15, 20 years, to be able to multiply your net worth. So this is just a snapshot of what venture capital and private equity looks like, and we'll get a bit more in detail on that and cover different aspects of it as we make new videos. So if you found this valuable, please comment below and let me know if there's anything else you want to know about private equity or venture capital, and we'll cover that in future videos. Thank you so much.